Welcome to Authors at Drucker. I'm Dave Specht, Senior Fellow at the Drucker School of Management. At the Drucker School, we aspire to become the global meeting place for the world's most influential business owning families. This conversation today represents progress towards our achievement of that objective. Authors at Drucker is an interview series where we feature top authors that write about issues impacting business owning families. Authors at Drucker is made possible from the generous sponsorship of the James E. Hughes Jr. Foundation. The foundation is dedicated to advancing the study of family governance and generational well-being, and we at the Drucker School feel very aligned and very grateful for Jay and his foundation. On the last Authors at Drucker, we featured Mark Anglesian, former HR executive for Microsoft, Amazon, and Walgreens. We discussed his book, Stakeholders, the Intersection of Human Beings in the Ecosystem of Business. If you missed that interview, please check out our YouTube channel for the replay. Today, I'm joined by Dave Whorton. Dave's the founder of the Tugboat Institute, an organization dedicated to serving evergreen businesses. Dave has co-founded several companies, including drugstore.com and Good Technology. He later worked at Kleiner Perkins, Caulfield and Byers, TPG Ventures, and Interwest, collaborating with founders in Google, Amazon, and others. At some point in his journey, Dave made a pivot from venture capital to serving the evergreen movement. Dave, thanks for joining us today on Authors at Drucker.
Yeah, thanks, Dave. Good to be here. And thanks for the folks joining us.
Dave, in your book, you share with some vulnerability, kind of the mountaintop moments and maybe some deep valleys that one can expect as an entrepreneur that's seeking to also be maybe a husband and a father. Maybe we'll start with a pretty vulnerable question. How do you strike a balance? What was your experience?
Well, my experience was that I couldn't strike a balance. And very selfishly, until I got married, I spent a tremendous amount of time at work, whether it be at Bain& Company or optical engineering, the laser company I helped get going and running. And then Kleiner Perkins was extremely long hours. We were kind of in the period of the dot-com boom between 97 and 2000. I was working for John Doerr, who was probably the venture capitalist every entrepreneur wanted to work with at that time. And so we were very, very busy. And so in general, I got married in 98, right after I joined Kleiner Perkins. And so my wife was working full-time in an ad agency, so I didn't have to have balance. And then, started Good Technology in March of 2000. My son was born the same week. My father had a major golf accident where he lost his left eye the same week. So suddenly, starting a company, market is starting to collapse. We had the dot-com crash that spring, as you remember. But I was off starting a company, trying to race to get the first product to market by September to support Handspring. So the hours were very long. I wasn't spending much time with my family. Over the next 3 years at Good Technology, where I was CEO and then later chairman, it was really difficult. And I talk about in the book's called Another Way, that I felt for the first time in my life, I don't know how to describe it. I called it compression. I just felt like I was just being squeezed on all sides. It was almost a physical sensation because, I wanted to be there for my wife. I wanted to enjoy some time with my newborn son. I was under extremely pressing demands to get big fast with Good Technology. And financially, the markets had really taken a swipe at us. We were also building a new house at the time, so that was happening. So we had way too many moving parts. And what I found over time, I ended up getting through that period by hiring a CEO to come and run the company. Still was very busy, but took some of the pressure off me. But over time, I had to find a better way to balance this. And though like many of us, I had a coach. His name's David Sorenda. And David really encouraged me to think about my work week, how much time for work, how much time for my family, how much time for kind of self-care and working out. And as I started mapping out the week, I realized there just wasn't enough time in the week. And so he helped with some really good guidance around, hey, look, when you're in this kind of stage of your career where it's growing at a very rapid rate, kind of a career advancement, and you have a young family, you're just going to have to make some trade-offs. But don't trade off the things with your family that are most important, like the holidays and vacations and time at dinner and reading books to your kids. Find a way to make that happen. So, an average day might be for me getting up very early, working out, being at work, let's say at 8, staying there till 6, getting home in time for dinner, putting the, bathing the kids, reading them books, and then getting back online from 8 to 11, something like that, and then working part of the weekends. But I started integrating at his guidance, some strong family traditions around food, around different events, try to make key moments in the kids' lives. And then over time, this got better. But there is a moment I think we all go through where, our careers are incredibly important, our young families are incredibly important, our spouses are incredibly important. And I don't have a silver bullet answer for it. Balance was not something I was great at, but I did find ways to kind of make sure we had special moments. And I guess what is meaningful to me is as my kids look back, they remember those times. They remember the times us cooking together. They remember the vacations we had together. They remember kind of the special traditions we had formed as a family together. So I guess it worked, though I would have, in hindsight, preferred to have had more time with my kids. That just isn't what you do when you're running a get big fast company.
Yeah. Well, I feel your pain. I have 6 kids, so
Six.
we still have 3 at home, and it is incredibly difficult when you're ambitious and excited about what you're building, and yet you don't want to leave the people that you love most behind to do that thing. And so I think there's a lot of entrepreneurs that really struggle with that. So I imagine the Tugboat Institute is probably a place where people gather to commiserate and maybe share, what some practices are, and to
Yeah, and I think,
normalize it.
most companies, CEOs are running evergreen companies are pacing the growth. They're not trying to grow at 100% a year like under the get big fast model, or at least 50% a year, right? You don't want to fall much below that. When you're growing 20% a year, 15% a year, 25% a year, year after year, it does create more space, for recruiting people, onboarding people, training them, building out your management team, and, taking that longer horizon. So you can have more room for your family and your spouse and friends. The get big fast model that is kind of what we do in Silicon Valley today just doesn't allow much room for that. I mean, you don't have enough hours in a day just to solve the problems the company is facing alone. So that's one of the benefits of evergreen companies, and one of the reasons why women are often CEOs of evergreen companies, because they find it affords them the ability to do a better job of balancing raising a family as well as leading their companies.
Very interesting. So again, you were co-founder of several ventures, worked as an investor for Kleiner Perkins and TPG Ventures. At what point did you feel like you started to see that the VC model had lost its way?
Well, I got glimmers of this right when I was transitioning into good technology. I mean, we were chasing things, we were moving really fast, we're making investment decisions quickly. The fund size when I joined Kleiner Perkins in 1997 was $150 million. The fund that was raised as I was leaving was $1 billion. And so that was a substantial change in size of the fund. The check sizes were getting larger. We were being very aggressive in trying to pursue the best leading firms that we could identify in a variety of different technical sectors. And so there was a shift there in itself, but I'm not sure it was a bad one. And that's partly why I went after good technology, went after the get big fast model with Benchmark and Kleiner backing me. But it was really post the Great Recession in kind of 2009. I thought after the dot-com crash, there'd be kind of reversion to the original Kleiner model or original venture capital model, away from get big fast, one more focused on profitability. And that didn't happen. And then '09, coming out of the Great Recession, and 10, the entrance of a lot of early stage investors with no investing experience was something I'd never seen before. And they were writing checks of reasonable size with no terms. It was basically convertible notes with no conversion price or extremely high conversion price. There was no offer to help the CEO build their business, build their team, think through their strategy. And they were winning. They were winning a lot of investment opportunities because basically they convinced entrepreneurs they don't need help. They just need a check. And they need a check which is basically free because it's not set at a price. It's very difficult. And this is when I was trying to do early stage investor, kind of pre-revenue, pre-product investments to compete with free. where I'm trying to make a reasonable investment, own perhaps 20, 25% of the company, go on the board of directors, get in a rhythm of meeting with these entrepreneurs on a weekly basis. And so that's when it started really feeling like it was shifting because it was the devaluation of kind of early stage experience company building help. And then that just continued over time. Another thing that was happening too is that we saw a real entrance of a different type of entrepreneur with the dot-com boom, and that sustained itself after. Where prior to that, most of the people that were being backed by venture capitalists had technical backgrounds. They were trying to make a technical contribution. They weren't doing this just for money alone. They really wanted to see their product come to life. By 2000, 2011, there was a ton of people, and I'm an MBA, but I'll say a lot of MBAs showed up and they wanted to make money fast. And that's what it was about. So you could feel that shift.
Yeah. So let's stay on this investment vein for a second. I've been thinking about, you call them these evergreen companies, and they can sustain themselves because of how they choose to operate, how they choose to grow. But I'm curious, what are the investment opportunities surrounding them? And I'll just give you one example that I'm running into with families that I work with. Uh, they they're doing well. They're doing great. They're very profitable, but they still have these pinch points where going from second to third or third to fourth generation, there's this constraint on capital because maybe the cash flow needs of non-operating people starts to outstrip, it can grow faster than the company is growing. And so there are these inflection points where it's like, are there off ramps for family members that no longer want to own the company? And do you see any investment opportunities for funds coming together or to truly just invest in these evergreen companies and become more like permanent capital to come alongside? Is anyone doing that yet?
Well, not that I can identify. At least not minority, non-control, unlimited duration investments, or let's call these forever investments.
Yeah.
There are people that will buy your company and buy a
Right.
majority of it or buy all of it, and they'll say that we'll keep it under the family umbrella, office umbrella forever. There's a few people that do that. But to truly be in a position where you're like, look, I really respect your company. I love the way you're running it. Yes, you need to buy out your sister and she has 10%. I'll buy that 10% position and just keep running the company the way you're running it. I don't expect to control you. I don't expect an exit event. I would hope that over time, as you generate excess cash, there'll be dividends for us. So I think there's just a bit of a mismatch, and it's a duration-based mismatch. Whereas, evergreen company leaders are thinking in decades,
Yeah.
and most family offices are thinking, we're slightly more patient than venture capital. We'll give you a little bit longer, but not forever. And there's a little bit of a challenge in the family office space specifically, if we're thinking about those as investors, is that many of the people on those teams are actually incentivized on their direct investments with a
Mhm.
piece of the profits of an outcome. And so,
Yes.
getting dividends isn't a very lucrative thing for the investment team at the family office. What's lucrative is having a big exit. And so there's kind of a natural orientation as they think to generate wealth for their own families, investing the money for the primary family, the exits actually get them there quicker. So, but it is an issue, and when I see evergreen leaders doing this, they're typically turning to friends and family. They're turning to people they deeply trust, and they're asking for their support for a very long period of time. And they may get dividends over time. They may get repurchased over time, but there isn't like a formal structure around it, and a very efficient market around that.
Okay. Yeah, my experience is that some of these older family offices, single family offices are trying to figure out the cash flow, the cash flow dilemma they have with this group that's growing. And I think they see private companies as the path. If there's a private company that's created incredible cash flow and they can buy a part of them,
Yeah.
I think they're looking for alternative ways to create cash flow because haven't been able to find it in the public markets.
Well, and it's a nice way to diversify. If you've got most of your investments are tied up in the primary company that your family owns,
Yeah.
but you are able to put some money outside of that, and that could be in a diversified public portfolio, could be a bond portfolio, could include some international stocks, might include some private equity and venture capital. But yeah, I could see why they might want to find some other companies similar to theirs where they're like, boy, I admire that family. I love the market they're in. They're executing well, and we can own a piece of that cash flow stream forever. I mean, that would be attractive. They just have to make sure they offer to that person they're investing in the terms that they would accept themselves in their own company. And when you
Yeah.
push them on that, that's where the jaw drops.
Yeah. Yeah, that's probably true. So, Dave, most of our listeners here at Authors at Drucker are either leaders of multi-generational family companies or advisors to those business leaders. I would say many naturally espouse some of the 7 Ps
Yeah.
of evergreen companies already, but can we just walk through the 7 Ps and then we'll dive deep into a couple of them.
Yeah, that'd be great. So, we call these companies evergreen companies. We've used that word a couple of times now, and it's really to kind of define a new category of company. It's not just family owned, it's not just employee owned or foundation owned or ESOP owned. It kind of invites all of those ownership types to be an evergreen company as long as they kind of align with and have intention around maturing on these evergreen 7P principles. And those 7P principles are purpose, perseverance, people first, private, profit, pace growth, and pragmatic innovation. And the idea is that you want to mature on each of those, but also realize that acts as a system. There are trade-offs within those. You have to be attentive to those too. Like all systems, if one of the gears locks, then it can stop the entire system. So you have to be thoughtful about that. And the kind that really kind of get you in trouble would be, for example, debt. Just far too high a debt, which would put you in a position in a downturn where you may not be able to make those service those payments, and you could lose your company to a bank. So you see in most evergreen companies, as a for example, very, very low debt, if anything.
So let's talk a little bit about what are some of the benefits of being private? Let's just dive into a couple of these. Why is private so important
Well, private
to
support.
be evergreen? To be an evergreen.
Yeah, to be an evergreen, well, it's because you don't have an exit event coming up. You don't have to shape the company towards, in the terms of a private equity firm, kind of a liquidity event in 3 to 5 years, in terms of venture capital, 7 to 10 years. So you can actually take very long planning horizons. And you're not trying to dress up the company for a future buyer, because there's a whole set of activities that private equity will do in anticipation of an exit that would not be necessarily good for the long-term health of the company, but will increase short-term cash flow so they can get a higher multiple, and on that higher cash flow, getting them a bigger exit, correct? Including, perhaps a lot of leverage. And so these time horizons are critically important. So you heard, some of these leaders talking about, 5, 10, 15, 20, 50, 100-year time frames. Like, is this in the best interest of our company as we think about this over a 100-year period? That's pretty cool. I never heard time frames like that in venture capital. The time frame was generally to the next fundraising. What's it going to
Yeah.
take to raise the next round of funding to keep
Yeah.
funding this money losing venture so we have a chance to continue achieving towards an exit of some sort. So that's one. The other is when you think in really long time horizons and you're a private company and you have owners that deeply believe in your purpose and in these values, you generally seek out win-win relationships. You're not looking to like screw somebody in your ecosystem to look better in the short term. And for example, jamming your vendors on terms or raising prices excessively to your customers. You're trying to strike a healthy balance. And so that, the ecosystem wins together. And I think that's a pretty powerful thing because if people start really being thoughtful about this as they think about their suppliers and or their customers, and they start seeking out evergreen companies, the one thing they can trust is going to be operated with good values. They're not going away, and they do want to win with you. So
Yeah.
there'd be a couple. And then the third, I guess I'd say, which has been more of a subtle thing, but I have picked up on this. And I talk about these things also in the book if people want to dive in more deeply, is this kind of higher consciousness about the leaders and the owner's relationship with other human beings. There's just a higher consciousness when you're a private company planning on staying private forever, operating to these principles, where you want deep relationships with your customers. You want deep relationships with your employees. You want them to have long tenure. You want them to develop and be trained, and be successful and lead happy lives outside of work. You care about these things because that's good for the business. It's good for your purpose. It's good for your communities. And so these are some of the things that are real benefits of being a private company.
Yeah, I mean, these are the companies that win the best places to work awards. It's probably not the company that is, on the treadmill of 3 years and out, or 5 years and out. So I definitely see that.
Yeah,
Specifically to generational family companies, I feel like one of the challenges is like keeping the emotional ownership of the business when people aren't active in the day to day. And there's a communication function around
sure.
how do I interact with those that are non-operating shareholders. In your tugboat group, what have you learned there about how they're interacting with non-operating shareholders? And is there any kind of are there any activities in terms of how to keep that emotional ownership or that emotional connection so they aren't just looking at, well, if I could get a better return somewhere else, then I should sell my part of the business
Yeah.
and take my money and go
And
out.
I think a lot of it comes in the training of the next generation when they're still young, and having them understand at a pretty early age what the purpose of the company is. And the purpose of
Yeah.
the company, if it's an evergreen company, is not to be a wealth generation vehicle as a primary reason for existing. It's something more important. It's some kind of impact in the world or way we want to treat other human beings or employees or et cetera. And so if they really understand the purpose and they understand that it was founded with that purpose is being sustained through the generations, they get hopefully almost wired into their brains that I wouldn't do anything to sacrifice the purpose of this company. It's too important, And grandmother, when she created it, it was under this deep purpose that I have to help carry forward as a steward, even if I'm not actively working in the company. And then you have just really good training, right? I think it's great to have kids work at a very young age, even if it's coming from a family of wealth. Learn a work ethic, learn what it means to be a frontline employee and do that hard work every day, day after day, because you have a deeper appreciation for what you're giving as far as an experience to those type of employees for your own company. And then learn, how to invest stock when you're a teenager. What is a share of stock? What does it mean? What is it entitled to you? And then maybe later, after they really understand that for public companies, let's talk about our company and who are the shareholders and what's that stock worth and what does it entitle you to as a shareholder? What things are within entitlement and not within that entitlement. And then, as there's a ton of great practices around, family gatherings, family councils, having some family members be representatives on the board, guidelines and rules about family employment so that, it's
Yeah.
just not nepotism and given to you. You have to earn it. Maybe you have to go work somewhere else for a few years out of college or high school before you come back into the business. But I think a lot has to do with just being deliberate, as you said, in communications about what's important. And so hopefully they'll really buy into it. I remember having a conversation years ago with Ann McMillan Pedrero about Cargill. Her family is owners of Cargill, and she made the point to me that there's no shareholder who's more important than our purpose. And if we have to sacrifice our distributions to make sure we protect the company, we will absolutely do that because to feed the world's population is a lot more important than any one thing we might buy with those resources. And I love that.
Yeah,
I mean,
that's
it's
powerful.
just so clear, and I think that's kind of an obligation of the current generation to make sure the next generation understands that. And that's why it's important to have a clear, well-articulated purpose and not just something you put on a poster on the wall, but it is who you are. It's how you think about strategy. It's how you think about trade-offs and the type of businesses you get involved in or stop being involved in, et cetera. So, yeah, I think this can be done well, but I would not let it be accidental. If you want your company around for 100 years, don't just think the next generation is naturally going to pick up on this and, be aligned in the way you'd expect.
I was just with a family this weekend that's modeling that. They invited their first kind of tranche of generation four, and that the message was we have 600 families
Family member?
that depend on us.
Two.
These are the employees.
Oh, right. Got it.
600 families, that depend on our family to make good choices with how we run the business, with how we behave. and really they were just instilling like not too much pressure necessarily, but they were trying to give a little bit of the magnitude of, look, the choices that we make as a family here um, matter across a wide range of stakeholders, and they did a beautiful job of it. And I think that that just needs to happen. I mean, it just has to happen.
I agree. That's good. That's well done by them, for
Yeah.
articulating that importance.
Um, let's talk about the Tugboat Institute for just a few minutes. Tell me about how it got started, and has the purpose evolved at all from when it started? Tell us a little bit about Tugboat Institute.
Yeah, so as I was kind of in a position to think about raising a third fund for Tugboat Ventures, which I started back in 2006 with a $50 million fund and a second fund in 2008 of 75 million, it was kind of time to think about raising a third fund. And I had pushback by one of the lead investors, just saying, look, I'm not sure that your model, this kind of highly curated, very hands-on, concentrated portfolio at the earliest stages is really working in today's environment with all these people writing checks with these uncapped term sheets that we talked about earlier. And
Mhm.
frankly, I couldn't argue with them. I said, I don't disagree. I think they're getting into very interesting projects. I don't know how much this will be worth, but it is, it's not really something I want to adopt as a strategy. And one of my advisors, Bert McMurtry, who was the chairman of the board of trustees at Stanford and also a very early venture capitalist in Silicon Valley with TBI, he said, Dave, you really have to do what's consistent with who you are and your values. And if the model's kind of really moved to writing lots of small checks to lots of people and just kind of praying that they work out and not really helping, maybe you need to find a different way of helping entrepreneurs, what's more consistent with the way you like to work and the values you like to work with. So that set me out on a learning journey to start reaching out to people. And I asked a pretty fundamental question, which was, who do you know that's ambitious to build a big company, but for some reason has no interest in venture capital or private equity and does not want to ever sell the company or take it public? And as you could imagine, as I posed this question in Silicon Valley, a lot of my friends there were like, not sure what you're talking about. I don't think you can say ambitious to get big and not raise capital. I don't know. That may be a null set. Exactly. So it took a while, and I started having these conversations, but I started meeting people like this, and some in Silicon Valley, some around the rest of the country, where they did say that. They said, we have a purpose that's really important to us. We don't want that affected by outside owners. We want to build something of significance. We're not in a rush, but we do have a sense of urgency. We want to, just kind of have this be a small company. And as I was talking to them, what they were saying to me is, are you meeting other people thinking similar to us? I said, I sure am. So I started making some one-on-one introductions, and that quickly I realized didn't scale. So in 2013, I decided to invite, I think it was 40 or 50 of these people I had actually had really good conversations with to get together in Sun Valley, Idaho, where I had a second home, and spend a couple of days together talking about what's it like to build a company that is contrarian to what everybody in the world thinks you should be doing, which is building a company to sell or take public. And then there's some best practices we can share with each other besides inspiring each other to kind of stay on the path. And in that very first day, had people up on stage giving TED-style talks. We did some outdoor activities, and I could feel it. I could feel the energy, the connection, the level of authenticity blew me away. I mean, they were telling each other things that a venture capital gathering like of Kleiner Perkins or TPG, or I'm sure others like Sequoia and Benchmark, the candor in which the CEOs were speaking with each other about what was really happening in their business, I'd never been exposed to before. Because
Mhm.
generally people in those circles are always trying to make it sound like things are great, it's up and to the right, we're perfect, up until the point they go bankrupt, right, the next day.
Sure, yeah.
So that night I hardly could sleep. And then I kind of presented to the group the next day. I said, look, you're the people I want to serve going forward. This is what I've been looking for years. People like Dave and Bill from Hewlett Packard with that kind of values. Would you be open to me trying to do something for you? Trying to bring you together, sharing practices going forward. And it was, just very enthusiastic ovation to that idea. And I said, well, great. Then I'm going to start Tugboat Institute, and I'm going to figure out a way to support and serve you guys with your help. You're going to have to give me guidance. And that was really where I decided, nope, I'm not going to raise that third venture capital fund. I'll continue supporting those companies I already invested in.
Yeah.
But over time, I'm going to feather in more just supporting evergreen companies than, continuing. And I made no other venture investments after that time.
Is Tugboat mostly North America, or are these families and businesses coming from all over at this
It's
point?
mostly North America. We do have Canadian companies. We have Mexican, Guatemalan,
Okay.
Italy. We've had in the past UK, Chile. Um, a big part of what we do is bring the people together in live events,
Yeah.
experiences to get to know each other. And so while I would be happy to have somebody come from anywhere in the world, it's just understanding that the current focus is geographically in North America. And so if you're willing to make the trip a couple times a year, that we're happy. We're not going to say no to you. Over time, I think we will find a way to be more international. I'd like to do that. And there's probably a transition plan towards that versus just kind of recreating what we've done in the United States, for example, in Europe. But we do think there's evergreen companies everywhere. We think they're everywhere in the world, in every industry of all sizes, all ownership types, all generations. And we do want to be of service to them. We have a two-part mission, or vision. And one vision is that for the members of Tugboat Institute, we're an unparalleled resource. They can't get better support, ideas, best practices, scar tissue, wisdom sharing, all of that. But we also have a commitment, and it's me and the current members, that we want to share that wisdom and best practices with the world. We're not going to hold this up and keep it a secret. We're going to make it available to others.
Beautiful, beautiful. Dave, we're in the midst of what many are calling a $100 trillion wealth transfer. Again, I everything I see is family companies because it's just what I live and
Is this
breathe.
the
But
national debt we're talking about?
no, 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 there's different transfer.
That is a wealth transfer too.
It is a wealth transfer as well. But with this kind of impending wealth transfer for these evergreen companies, what are some of the big opportunities that they have, and what are some of the big obstacles that they face with this transition that's coming?
Yeah, and I think what you're saying is as this current generation of owners thinks about what they want to do with their ownership in the business going forward, correct?
Correct.
And so, it's like all things, there has to be a plan. There's got to be a plan for transitioning control, ownership, and leadership. All three of those have to be kind of thought through. And the earlier, the better, not to put pressure on founders or people young in their generational cycle with their family businesses, but a good plan is extremely helpful. And it's really going back to this purpose comment. Are you committed to the purpose of the business for the long haul? Because if you are, and you like to do this together as a family, then you need to think those things through. And it goes back to the earlier comments you made, and we talked about training the next generation so they really want to be stewards of this business going forward. But of course, if people are not aligned with the business, it's not something they want to do in the next generation. You have to have a way to get them out. You don't want them trapped. And so there probably needs to be some kind of a buy-sell agreement that's put in place that's got fair, maybe not market pricing, but fair pricing so that those people over time can get removed from ownership and the people that are really committed to go forward maintain themselves in ownership. And I also think there has to be a real clarity around what is the roles going to be of that next generation in the business, and not to set the expectation that one of them has to be CEO of the company, even if all the prior generations have, because it may be time for a professional CEO. Or
Yeah.
maybe a professional CEO before it becomes a family member CEO again. And there's a lot of really important roles family members can play without having to necessarily be running the company.
Yeah. One of our mutual friends, Dennis Jaffe, did a study of
Mm.
100 families that made it past 100 years, and 97 out of the 100 had one thing in common, and that was they had a path to liquidity that was available, it was communicated, it was clear. And I think that's so powerful because then you have owners by choice rather than owners by force, which is I think where the magic is. I mean, when you have people that want to be there and are committed to the purpose, then it really can work. But where there is no path to liquidity, I think that's where you start to have the fractures.
Well, and you get weird behaviors in that case because you're right. They feel trapped. They see a lot of their network tied up in the company. Maybe they're not even involved at all in the business. Like, wow, substantially all my net worth is over here. I don't know what's happening. I'm not sure I trust leadership. Then you get these weird behaviors where then they start talking to private equity guys or lawyers and saying, how can I kind of get this out? And so that kind of hits on something that's really important. And Dennis talks about this. Spencer Burke talks about this at Olin. family harmony is really important. And
Okay.
if you have this kind of liquidity tool in place, it actually, to your point, really facilitates family harmony. Because if you're not happy, let's find a way to get you out versus having you start undermining the leadership team or talking behind people's backs or trying to build a kind of subset of the owners to kind of demand certain things from the company. It's just better to have them get what they want and get them out.
I agree. I agree. Um, So some of the unsung heroes to these multi-generational success stories are the non-operating spouses. And I've witnessed them kind of be the glue. I've witnessed it in my own family. I mean, my wife is the glue to what holds us together. So I'm curious what programming or support is out there for these spouses, that kind of non-operating spouses to these multi-generational companies. Is Tugboat doing anything for that group?
Yeah, well, first I'll say I agree with you. In many cases, the spouse is critically important. Even if they're not actively thinking about the business, if they're helping the, let's say, the CEO, family member, operator maintain focus on the family business while they take care of the family and other family needs and stuff like that. It can be a very powerful partnership. And I'm not necessarily suggesting the spouse is actually just a stay-at-home dad or mom, but if they can actually help, because nothing worse than worrying about your children while you're trying to make a major decision in your business, right? And so I think there's, all levels in which a good partner really helps the success of the person who's actually trying to lead the business. As far as programs that we offer, we do not have a formal program for spouses, but we try to acknowledge the importance of spouses. We do content around business, family, and life, and that will touch on things related to trying to be a good building a good evergreen family, kind
Mm.
of is your role as the kind of the lead operator in the business. We invite spouses to come to our summit during the summer and spend time together so they can bond with each other and network and kind of develop some of their own conversations. We also have a thing called Gathering of Teams in February, where about 600 people get together from about 100 companies, and that does include spouses too. And the spouses have an opportunity to have their own track where they can similarly experience all the talks that everybody else is experiencing, but have some time also as a group to talk about what are the unique challenges they're facing as spouses, and how can they get support from each other too.
Yeah, there's two big ways that I think spouses really can exert a lot of great influence. One is I feel like they're the story keepers. Like whatever story is told to the rising generation about the business, it can easily be dad or mom is trading time, and we're in competition with the business. And so there can be this negative story that's built around the company, or it can be completely opposite. It can be this kind of glowing story about what's happening with the company, and we're so happy, we're so proud of whatever's being built.
I like
Um,
the latter a lot better.
yeah, I know. It's a lot easier for sure. But then on the planning side, I think that's where I think most advisors go wrong, is underestimating the spouse that isn't necessarily running the business, because they understand many times better than the founder how shared ownership might work with children, or
Right.
what are some of the things that they worry about in terms of enriching their children at too young of an age. And anyways, I just think there's a lot of opportunities to work with them, engage them, and help them be a part of the process to contribute to these
Well,
companies evergreen.
I think critically important in the toughest of times. The spouse can play a critical role in supporting the individual who's at the front lines of those very difficult challenges.
Yeah.
And again, I've heard this over and over from members, which is, my wife during this period or my husband during this period was phenomenal. Just making sure that, I was getting sleep, I was, exercising, that I was thinking clearly, just sometimes just being a sounding board for them to clarify their thoughts. So no, if you have a wonderful spouse, you are very fortunate, and it's a tremendous asset to the firm.
Yeah, I tell my kids every day it's the most important decision you'll make in your entire life.
I
So
agree on that one too.
wisely, choose wisely.
Yeah.
I'm going to ask one more question, but before we open it up, but I want to open the opportunity for our attendees to start to submit your questions in the chat, and we'd love to have you join with your voices on the call. Um, so let's dive into a couple things. One of Peter Drucker's principles that I find so fascinating is this concept of systematic abandonment. And as I was reading your book, um, I was thinking about this systematic abandonment, or maybe a different way of saying it is like strategic stopping of some activities. And I wanted to see how that might pair with pragmatic innovation, which is one of the principles that you talk about in your 7 Ps.
Yeah, yeah. So a piece of that is definitely pragmatic innovation, but you have to kind of know where you want to be innovating. So I would actually step up a level and say, first, you have to start with your purpose and be really clear about what your purpose is, because your purpose should sit at the headwaters of your strategy. And if your strategy doesn't actually bring your purpose to life and reinforce the purpose, then you've got the wrong strategy or you've got the wrong purpose. But those should be actually working in pair. And as you think about strategy, one of the key things you need to understand is profit. Where are you making money? And so there's a whole series of things you can do looking at product line profitability. You can look at customer level profitability. You can do a thing called the profit whale, where you look at where total profits come from. And when many people do this analysis, they find out that there might be 20, 25% of their base of customers, which they're actually losing money on. And it's actually driving down their overall profitability because of the time required, the customization, whatever it may be, or they're not big enough, or what it might be. And so you have to have a discipline. And so as you're doing that pruning exercise that Drucker talks about, that's an easy place to start, which is let's get into the things that are not profitable today and we don't see being profitable in the future. Now, if it's not profitable today, but you have high hopes for it to be an important product in a new market over time, that's a different question. But if it's just you don't see it changing, prune that, because focus is
Yeah.
critically important. And you're right, companies can continue growing, adding complexity. You need to remove that complexity over time too, and focus helps doing it. So strategy is really important as it pertains to honoring your purpose, and then your pragmatic innovation. So your question really kicks in, which is, hey, look, here is an area where we want to innovate a new product on behalf of our current customers. And so it's a pragmatic innovation exercise. So you might run a series of experiments and see what's actually working and not working. What do the customers really value? And then this is what we call like digging a lot of holes or planting a lot of seeds, seeing what actually gets some positive market feedback, looks like can achieve kind of what you need to do as far as margins on that product, and then continue investing into that opportunity. So yeah, they kind of all work together. And then the other point I'd make about this, and Herbert Joly does a very nice job of articulating this book in his book, is that as you look at your current product lines, also look at how they align with your purpose or not.
Mhm.
Because maybe they're profitable, but they don't really align with your purpose. And it's better for you to get rid of it so you can focus on those things that do align with your purpose versus continue on something that doesn't. For example, would be, for a while there, most of the major drugstores were selling cigarettes. Well, if you believe you're in the business of helping people be healthier, you can make an argument that you shouldn't be selling cigarettes. And I think it was CVS came to the determination, they're very profitable line to have. They could not continue to sell those because it wasn't aligned with their purpose.
Yeah. No, that makes a lot of sense. Um, okay, no questions yet. Come on, people. You have a chance not every day to talk to Dave Whorton, so jump in here. Oh, here we go. The questions are coming in now. So let's turn to Francisco. Do you want to join your voice to the call and ask Dave your question? Francisco Valle. You want to unmute yourself? Let's see, did Francisco drop off here? All right, I will ask Francisco's question for him. He asks, what's the best model or framework or process to use to value a newly created company or evaluate a newly created company?
And do you think he's saying this as a founder who's thinking about creating a new company or somebody who might be investing in a new company? Maybe.
Francis,
Yeah, yeah,
Francisco,
I can speak now. I'm sorry.
go ahead. Thank you.
Yeah, thank you. Um, yeah, it's both ways because on the one hand, we always believe that our baby is the most beautiful baby in the world, and on the other hand, right, is from the investor perspective is they always invest the least possible and get the more share in the company.
Yeah, I think the way I'd probably take this on Francesco is thinking about what I would advise a founder in starting an evergreen company. And what I would advise them first, that individual has to understand they prepared for this journey. They prepared for what's going to be a very tough process. No matter how well things look like from the outside of most startups, you will have some pretty tough periods, and are you there? I mean, do you feel like you've got the psychological makeup and background to kind of take on that kind of hardship? And that's important. The second is are you building something that's aligned with your own personal purpose? That's really important. This is one of the faults I have with the incubator companies in Silicon Valley, where they encourage entrepreneurs to just throw stuff against the wall and see what sticks in the marketplace and then build something around that. I don't think that's creating a strong foundation. I think it'd be much, much better if you were to say, look, this is what I think my contribution should be over my lifetime in creating a new company. It's a certain market, that's a certain type of customer, employee experience, but get really clear about what your purpose is. Because again, that'll help you get through the tough parts, but also help you recruit people because you're going to need people to help you bring this to life. And then I think the next discipline is to come up with a business model that's cash generative. And to quote Clayton Christensen, very famously, he's passed now, but was at Harvard Business School and wrote a lot about disruption. Innovator's Dilemma, I think, would be the primary book. Is he said, we've lost the art of being impatient for profits and patient for growth. The world's focused on growth over profits, and the way you can build lasting, strong foundation companies is get to early profitability and build from that, and be less concerned with growth. So that would be the other thing that I'd be saying to them: think about your business model, think about one that gets you early cash, think about being impatient for profits, because if you can get to profitability in an interesting market segment, be small or large, that's aligned with your purpose. You can get happy customers, start recruiting employees, and do what you can to make sure they're having a good experience and they're happy. The profits are going to follow, and then over time, the scale will follow too. Particularly if you're dedicated to spending the rest of your life on this, next, 3, 4, 5 decades. As you guys know, you can grow at 15% a year for 30 years and you're 266 times bigger. I mean, you will get scale over time. Maybe not in venture timeframes or private equity timeframes that view these growth rates as very low to extremely unattractive, in fact, unfinanceable. But if the goal is to serve those customers or those employees for the rest of your life, that compounding can lead to very impactful large companies.
Dave, I think we need to really focus on driving this message into the youth. I mean, this is such a better perspective, a better mindset, a more realistic approach towards building a life and building a business. But it's only those VC backed and unicorns that get all the attention. And so I think the youth of this rising generation think that if I can't be a part of a unicorn, then I'm not really an entrepreneur, which seems crazy. But I mean, I don't know if there's any kind of work being done or content being created that we can drive down into the younger people. But it just seems like, even from a mental health perspective, like this building a company that is impatient towards profitability and growing in a measured way, like that just seems like we could create a lot more entrepreneurs if that was the perspective of this is what success can look like, rather than if you don't have a unicorn, you're not a real entrepreneur.
Well, and importantly, this model doesn't require outside funding, or at least beyond some modest, maybe friends and family. And so, in my mind, this is a path that's open to everybody. You can be a minority, you can be a female entrepreneur. Those two groups do not get served very much by venture capital today. It's like single-digit percentages, and I'm not going to fault the venture capitalists because I know their model, I know what they're trying to achieve. They're leaning hard on people out of Stanford, computer science, stuff like that, because that's what the patterns say. That's where these big breakthroughs come. But if you flip it and forget the investors completely and just say for these individuals who would like to build something very meaningful to them, this is a much better path. And I'd like also for people to realize from some of these groups that are underserved that they're often told when they have any modest level of success, you need to sell your business and capture your wealth while you can.
Yeah.
And I'd like to give them confidence that that may not be the right idea at all, and maybe better, yeah, diversify a little bit outside of the core business with some distributions. You may be put into, like an ETF around the S&P 500, but keep scaling that business, because again, at 15% for a 30-year period, you can build something really significant. And if you sell it in year 5, 6, 7, or 8, take $5 or $10 million off the table, you've missed the entire opportunity because 30 years later, you would have generated $50 million of cash on that same business, 75 in a year. And so we
Yeah.
got to paint that picture for them to see that, playing this long ball in a more paced way from their own profits can lead to really significant companies that are achieving their purpose. And as a byproduct, they're generating real wealth for the owners, which I hope includes the employees over time.
Yes. Dan McPherson, let's go to you. Do you want to add your voice to the call and ask your question to Dave?
Yeah, I feel I always have to add context to my questions because they're a bit more abstract. Pleasure being part of the call this morning. So I'm just finishing up reading Wealth 3.0, which has admittedly left me with a bit of an existential feeling of what is the right way to do this, right? We're trying to move away from this sort of fear-based, it's not about just the taxes you save or talking about shirt sleeves to shirt sleeves, but really this positive psychology. And then I thought of the movie The Martian with Matt Damon, where when they did it, they didn't want any sort of hypothetical things. They wanted to use existing technology today that they could use. So I'm sort of at this inflection point of we know that the model needs to change. We kind of know what it needs to look like. And as I hope a steward of this area that is so fascinating to me and so important, and again, very much bought into the purpose, wondering what sort of skills or tools to continue to cultivate that exist today that will put me in, the right place into the future. So Dave Whorton, your comment on the learning journey and, saying, hey, we're looking for this thing and everyone's saying it probably doesn't exist. I thought you might have some interesting insights on what skills to practice.
Help me with this. Towards what end objective are you shooting for in the development of
I
this?
think to be the family wealth advisor that families deserve, right, while balancing the need for profitability, right? So wanting to do that excellent work, even though it's probably going against the mainstream of saying, well, you can't do it that way. So what are those just time proven fundamentals to go, we don't exactly know where we're going to land, but we know that this is a skill that will be necessary into the future in this space.
I'm sorry, is that a skill as an operator or an advisor?
I guess as an advisor. Yeah, as an advisor.
Yeah. I'm not sure I'll have a great answer for you on that one, to be honest with you. My reaction is you just have to read everything you can get your hands on to have the broadest perspective possible, and then also be really a great listener to the people you're engaging with to make sure you really understand what they're after, not what we might want them to be after, And I find it hard to find really good advisors because I think many advisors have fairly rigid thinking about what's right. And if you look like in the wealth management space, I mean, diversification is the drumbeat, right? I was a member of YPO for a long time, and one of the interesting shifts I saw during that period of time was a real focus on, hey, have you thought about selling your company? Because you've got all your family net worth tied up in a single share of stock. What if something bad happens, again, like COVID, and your business goes under and you lose all of it? And you have a responsibility to your family, to your children, to your future grandchildren to diversify that wealth. And so people feel pressure to realize that. And what they don't hear is the other side, which is, well, let's talk about the other side of this. What can that business represent to your family? And its attachment to that brand and the qualities and values that are associated with it and the impact in the community and those 600 employees that are counting on us, right? There's not enough of talking to the other side. I found that really interesting. And I felt over time there was less and less people who are willing to kind of champion the idea of taking what might be perceived as the riskier route of continuing to build a family business versus the diversification and then put money into VC, private equity, diversified real estate. I mean, it looks pretty on paper, But the one thing that, like I said, one other thing I guess is not talked about too is how do those people feel after they've just sold that business?
It's
And
rough.
I have met a surprising number of people that are very depressed. And I remember one guy, I won't cite specific names or companies, but sold his company and then went to the gates of the factory about a year later, just wanted to walk the floor, just wanted to say hi to the people. And they were turned away by the security saying, I'm sorry, you have no right to have access to this. Just broke his heart. Stories like that. And, there's been, many who have said, I sold it, I thought it was the right thing to do. I took care of my siblings and myself. I'm not sure what to do now. Now I look at like prospectuses for private equity funds, where what I used to do is sit down with employees and help them solve tough problems and just have the pride of knowing that I'd help them develop themselves as better leaders. I'm not having that experience anymore. So that's the other thing that's not talked about, which is like, yeah, okay, so you're going to get diversification. What's going to happen to you psychologically? And also the separation from the family. We had one really sad story of a company in St. Louis where the brother teamed up with the dad to basically throw out the brother who had built the business from 2 million in revenue to about 250 million in revenue and was grooming his daughter to be the next CEO. They kind of surprised him at Thanksgiving and said, "We've decided we want to diversify." Unfortunately, the brother, I think a private equity firm had been in his ear for quite some time, and it was devastating to the family because it ripped the family apart. And worst of all things, the daughter who was being developed into the leadership role of running the firm no longer had a company to run. Just talk about heartbreaking because you wanted to carry the family forward. So, I guess I don't know if I'm answering your question well enough.
No, it's a profound answer. It's great.
Yeah. Okay.
Yeah.
Dan, one thing I would add to that is there is definitely open space for advisors to focus on the unique needs of family-owned companies and not towards the exit. Like every financial advisor wants to be there before the exit so that then they can manage the liquidity. But if there are actual services that you're offering to a family that is preparing a rising generation to know what it's like to be a shareholder, to be a good beneficiary, to understand what the relationship should be like with the trustee, and not just focusing on those that are pursuing liquidity events, there will be space for you. And it may not be like an assets under management sort of a business model, but there are business owners that have families that are large that need advice. And it isn't just about asset allocation. So I think whatever you can do to really humanize the advice component of a financial services practice, you're going to look very different, very different. And there's not very many people that are doing it because everyone wants assets under management. Everyone wants the liquidity event.
And then Dan, my last thing you talked about, take advantage of a learning journey. Go spend a year and meet with a lot of people that you would like to serve and just ask them, what's missing, what could be done that would really be valuable to you. And then perhaps in that you're actually building your future client base too. But I wouldn't rush it either. That's one of the powerful things about learning journeys. It's not something you do until you get a couple of boxes checked. It's something that you give yourself freedom to have over an extended period of time and really see the full input of a lot of different people towards that. That was so powerful about my learning journey was letting it take over a year and just seeing it reinforced over and over. Now, there were some exceptions, right? There were some conversations I had and the person's like, hey, I probably should have told you I've actually raised private equity, but I was really curious about this idea you had. And that's fine. That person was not invited to Sun Valley. But yeah, I think that's a good opportunity for you to really understand, to Dave's point, what's missing out there that you could potentially serve.
Yeah. Thanks, Dan. Good question. Dave, our time has flown. We are past the hour. I want to thank you again for joining us to feature your book another way. I will be sending many copies out to clients that I have and will be your unofficial ambassador for the Tugboat Institute.
Welcome to ambassadorship.
But I appreciate you joining us on Authors at Drucker and for sharing those perspectives and for doing the work you're doing. It's so valuable.
Yeah. Well, thanks for having me. Thanks for the work you're doing. And again, thanks for the folks that joined us.
All right.
Take care.
Thanks everyone for investing your time with us today.
Thank
and
you.
we'll see you next time on Authors at Drucker.
Thanks, Dave.
Take care.